So just a little bit of admin stuff too as we kick off. We'll keep Q&A throughout the session. If you guys could use the chat window, you could stay on mute just so we can keep the flow going. We'll take about 20-25 minutes to go through. Brian's got some really great content for us. I'll let him speak to that in a second, and then we'll wrap up with maybe 10-15 minutes of Q&A. Whatever is open, and we'll go from there. Sound good, everybody? I'm not expecting you to respond. I asked you to stay on mute. So, hey, Brian, if you wouldn't mind, we'll go ahead and share, and we'll kick off with this month's topic, which is underwriting debt in some very volatile times.
Yeah, thanks, Andrew. I appreciate it. And let's see if I can get my screen shared.
We're in.
All right, perfect. Let me see if I can. Is that showing the full slide?
We're seeing the split view right now.
Okay, one second. Let's see if I.
It's hard to tell every once in a while. I still got that wrong. We're good. We're good now. We're good.
All right, perfect. So yeah, so these are quick disclaimer slide. My views only. Opinions, not facts. I'm no expert, so like the rest of you, I'm a real estate investor that just learning something new every day. But I have underwritten several hundred deals, and I feel like I've learned a little bit on the way. A lot of what I'll talk about today, I feel like I'm taking from a deal late last year as well in Austin with bridge debt. In addition, I've invested passively in just a variety of structures and sponsors and see opportunities almost daily across my inbox. And I try to talk to debt brokers and lenders every few days. Alongside a couple of good friends of mine, we invest with Gen Wealth Capital Group. We've got about $150 million of transactional experience between the three of us. 1,900 units bought since 2016 across really some core MSAs in the Sun Belt area. And we've had 4 cycle deals as a GP and JV team, and really focused on generally, historically speaking, workforce housing, multifamily value add opportunities. So myself, I'm actually from St. Louis. I'm not from Texas. I found my way down here in college as a Texas A&M Aggie grad. Got into oil and gas. About half my careers in that area was focused on large $100 million plus type deals. And I've LP'd on about 2,000 doors in multifamily, some self-storage, ATM, senior living, hard money, et cetera. And so really started to get interested in the space more in 2021. So all of that's been fairly recently. And then I'm a GP on about $20 million of assets. So just to kick off today, the topic that Andrew wanted to bring forward was underwriting debt in uncertain times. So this is really the view from a sponsor. I mean, I think last month we had about 20 folks on and spoke with a lender, a mortgage broker, I should say. And so we really dove into some of the nuances there. And so that's not these first 2 slides are more just reference points, right? There's a lot of different types of debt that a sponsorship team can use on a multifamily deal. These are probably some of the more common ones, whether it's a bank loan, your agency, so Freddie and Fannie, and then your non-recourse bridge. This is a slide from an Old Capital webinar this month here in May. I highlighted the max LTV because really that's what, in my opinion, has changed the most just in the matter of, 6 to 8 weeks. It used to be no problem to get mid 3% interest rate on bridge debt, lever up to 80%, have 100% of your CapEx financed at all. And that's changed quite a bit. I'd say, generally speaking, I'm seeing something more like 65% of purchase price or LTV, which stands for loan to value plus CapEx. And so you're talking more like a 70% loan to cost on the bridge debt. That really can affect your underwriting, that 10% move. And then in addition, on the logistical side, you've got to go raise that amount of capital, right? So you might find yourself having to raise, hundreds of thousands or millions of dollars more to fill out that capital stack. The agency, I had actually spoken to probably 3 or 4 brokers in the last few days because of some variety of deals, and they just continue to see those groups, unfortunately, not really compete on the majority of value add deals. You're talking 50s when it comes to like percent LTV. That bottom row in this table that Old Capital put together, you can see the rates, for a fixed agency are in the high 4s. So they just really can't compete, even though the floating rate might be a little bit better than what you can get on bridge today. The extremely low leverage that, and bottom line dollar amount you can get from the agency just does not make most of those deals pencil.
Hey, Brian, for those that maybe you're in the newer in the space, could you explain when you say fixed and float, what does that mean?
Yeah, I appreciate it. And I'll try my best to try to explain all the acronyms, et cetera. So there's really two different types of debt. You've got your fixed interest. So your interest payments are fixed. So let's use the Freddie Mae conventional. So sorry, Freddie Mac conventional. So, you today, let's just say you're fixed 5%. So if you had a loan, you'd be paying 5% interest rate across the loan term. Let's say it was 7 years every month. A floating rate, there used to be a curve called LIBOR that was an index rate that then these banks or agency lenders would have a spread, and that's that floating spread. So that's that 2.75 to 3%. So if your LIBOR, your index rate was, let's say 1%, then your all-in rate would be 3.75 to 4% in that example. And so those are the two different pieces. And I'm glad, Andrew, you asked, because we're definitely going to focus the most on floating and bridge. In addition to that, I want to make one more note. If you have talked to different lenders or gone to some conferences, you heard a variety of numbers. I'd say, around 75 to 90% of a lot of what these shops did in 2021 was bridge. Historically, a lot of the sponsorship groups have used agency. That totally swung during and after the pandemic with how aggressive the bridge lenders were willing to get with the leverage, and then just really fantastic rates. Now you're seeing more of a mixed bag. I was talking to a gentleman on the way home this afternoon, and there's just a million different ways to skin the cat. I believe you're starting to see some more banks enter the scene. The nuance of the bank debt is that oftentimes it has a recourse component. And personally, heading into periods of uncertainty, I'm not sure I want to take on recourse debt, which means that you can be on the hook for some of the liabilities versus your bridge debt and other types of debt that would be non-recourse. So just some introductory commentary. I guess one more thing on the bank loans to point out would be that they're amortization. So you can think of that a lower number means that you're going to be paying off that loan essentially in the mortgage calculator faster, so your principal payments are going to be higher. So that's going to boost the cost a little bit, and sometimes has a shorter term than some of the other types of debt. So why are the agencies not really competing right now? And it's because the agencies base their underwriting on what they can loan out on something called a DSCR, so debt service coverage ratio. And they're always looking in the arrears, so the actual financials that the property's been running at, and they're looking for a 1.25x coverage, generally speaking, or higher. And so with where rents are growing so fast, and a lot of these properties that many of us are probably trying to purchase might have some distress component to them that we're trying to improve upon. It's all that math oftentimes makes it hard to get a large loan amount. You compare that to something like a bridge debt, and those lenders are looking at pro forma, your pro forma underwriting. So they're typically asking you, what's your year one pro forma, which is your estimated business plan. What's your year three pro forma? And we'll get into that a little bit. So they're forward looking. They're looking out in the future at your estimates, which, of course, if you're buying a property, you're estimating that you're gonna be able to increase the net operating income. And so they're able to lean into that more and give you a larger loan amount. We're not going to talk about it really today, but the other piece to really think about when you're looking at agency debt is the prepayment penalty. It's easy just to put a fixed rate agency debt 7 to 10 years in your model, but if your business plan is to sell after 3 years or 5 years, you should be calculating what that yield maintenance or defeasance penalty. They're just different terms that address the same issue, which is that you are paying off the loan before the end of the term, and so you're going to owe that you could potentially owe that lender some money. And there's some resources out there that I'll point to. So what are today's really debt key considerations and I guess mitigants, in my opinion. So first off, most underwriting models don't account for changing interest rates. I know Andrew and I have looked at a variety of deals together, have looked at a variety of models, but the majority of them don't account for changing interest rates. They have one input for a debt interest rate. And this flies in the face of that fact that I mentioned that the majority of deals that are bought in the U.S. are bought with floating rate debt. So there's a big disconnect there. So, how
Brian,
do you mitigate?
I'll pause on this one. I think this is a big one today that you and I have seen, and I know you've seen hundreds of examples where people will ask, like, what do I plug in? Like, if you see that 2-3% swing over the next couple of years, do I just take the middle point? Do I plug in the high point? So that's something I think we'll drill in on, and it's probably the meat and potatoes behind this presentation. And people want to know about, like, what the hell do I do with that, right?
Yeah, exactly. I think, there was a lot of deals probably as recently as a month or two ago where I'd see a sponsor send across a deal to potentially invest in. And you could quickly tell they were using, I'm just going to say, like 4% fixed interest over 5 years, because you'd see their pro forma cash flow estimates. And it was just, you could do the math, and it was 4% each year. And so, but they were buying the deal on bridge debt. So all they were doing was taking that spread on the index and adding it to today's index rate and assuming that wasn't going to rise, which if you were paying attention to any of the guidance from the Fed and just some of the news headlines, you knew that there was a risk. And sure enough, the Fed now has raised rates faster than they have in like 20 years. And the general market consensus is that we'll continue to raise rates the next few meetings. So what do you need to do? So you need to customize your models. It's very easy. You don't need to be a spreadsheet wizard, but just build in something where at least on an annual basis, you can put in if you're using floating debt, what your index rate is going to be, and account for that forward curve, especially when it's like it is today and it's steeply in contango, and that means it's rising, right? So a few months ago, it was almost 0%. Now it's around 1%, and that thing is headed to 3% plus if the consensus estimates are correct.
I got one quick one for you. I know I'm trying to keep the flow going here, but it just coming to mind. I mean, others are probably thinking of, is it as an annual rate change good enough? Do we need to get down to monthly? Is there a big delta?
I would prefer monthly, and I'll show you why. And just let me come back to that.
Great.
Bridge debt's still the most popular, but the market's tight, and I mentioned that on the first slide. It's no longer 75%, 80% plus 100% capex, where you could lever up into the 80s. And so really, if you've got some rule of thumbs that you're generally underwriting deals with, at least on every week or two basis, just get a hold of, some of your favorite debt brokers, get an idea. It doesn't have to be for that specific deal that you're looking at, but it's great to just, I've got a post note in front of me, sitting right here, just like, what's kind of the general for that market you're looking at, and that type of value add class of property that you're looking at. What's just some general ranges that you can play around with. Floating debt lenders are require something called a rate cap. We'll talk about that. What it is to protect their investment, they're going to require you to buy a rate cap that's going to set a limit at how high that index rate can go that you will pay interest on. But boy, they've gotten expensive. We had about a $21 million deal at the end of last year, about a 2% 2-year rate cap. It was about $50,000. We thought that was expensive. That same one would now cost us several hundreds of thousands of dollars. We talked to folks in the space that are in the middle of negotiating a deal, and their rate cap has gone above $1 million, and these deals are falling apart because of that. So you need to be checking the interest rate cap cost frequently, daily, when you're making an offer, and just be prepared for some volatility, and make sure you add that in your closing costs. And all these we're going to have a touch on a slide or two. Supply chain pressures, inflationary pressures, tight labor market have pressured various cost control centers. So items like R&M, turn, make ready, payroll costs. So I think to try to mitigate that, just make sure you're looking at the latest, like T3 trend versus T12, get with the local PM, adjust your rules of thumb. We've all, if we're interested in this space, have read books like Joe Fairless' book, the Bigger Pockets book, Michael Blanc. They all have kind of rules of thumb for payroll, et cetera. But I found that almost every single one of those expense line items has gone above the maximum that you read about when you began learning to invest. And I use the example here, $1,300 a unit payroll is not the upper end. Just saw a deal in Austin the other day that's, if you were to use the PM's budget, that number is closer to $1,600 a unit. So very market specific. Make sure you've got your finger on the latest pulse. Along the same lines, renovation costs are rising. A lot of times rule of thumb is probably $5,000 to $10,000 a unit on CapEx is a good rule of thumb before you go tour or perform DD, et cetera. That number, especially in hot markets such as some of the ones down here in Texas, is $10,000, $15,000 plus. So talk to your local PM or GC and carry additional reserves and liquidity. And lastly, a lot of those are considerations, right? But at the end of the day, we're all investing in multifamily because we believe it has very strong fundamentals. I want to be invested in the space, diversify my personal portfolio, also buy additional units as an active sponsor. But the reality is that the current rental growth cannot sustain either. And so make sure you support your underwriting market growth estimates with real research, whether that be CoStar, RealPage, Yardi, or something else. All markets in the U.S. aren't going to support 3 to 4% long-term growth. We'll look at what the historical growth been. It's been typically lower than that. And so, or if you're thinking about passively investing and the sponsor is using 5%, ask yourself what the support is for that, and think through some of those pieces. So this is just a screenshot of, don't have the name, but these are 4 pretty commonly used screenshots from underwriting models that are free to use. Each of them you can see just uses a one cell input on interest rate. So you would just type in an interest rate, loan term, loan to value, et cetera. So that just doesn't work when you've got something that looks like this. And so if the majority of your deals are being purchased with floating rate debt, whether that be bridge, agency, floating, bank, this is a SOFR curve. So I'll pause for a minute. I mentioned historically the most common index used that a lot of these lenders would use was something called LIBOR. That recently switched to SOFR for reasons you can go read about online. It's the secured overnight financing rate. So this is the rate that banks lend to each other. The graphs from January of 21 until for the next about 8 years. And so you can see is, all intents and purposes, almost 0% the last year and a half, and began to jump as the Fed has raised rates at this last meeting or two. And the market consensus again is that the Fed will continue to raise rates by 50 basis points or 0.5% at each meeting. And so you can tell you started at 0 and you're almost going exponentially up to almost 3% by March of 2023. That's a huge impact. I can speak from that personally, with floating rate debt. If you've got, or even, if you've got an adjustable rate mortgage, if you've got a HELOC, a line of credit on your brokerage account. I mean, this is a big deal, right? When you're now adding 3% to your borrowing costs on any type of debt, especially these multifamily assets, if you've levered up to 70 to 80%. So, how do you account for that? To Andrew's earlier question, I'd say the most useful and resourceful website I found is this Chatham Financial. So this website every day updates their rates. You get a LIBOR, SOFR, and then your various treasury curves. So I'm actually going to click on it here. And so, whenever I'm underwriting a deal, I'm coming out here. There's a nice, easy download. Sorry, I guess you can't, Andrew, you can't see the screen, can you? Because it's just showing the PowerPoint.
It's just showing the PowerPoint.
Yeah. Hold on one second. Let me share my actual screen.
Yeah, I think that'd be good to show, because some of the questions I got leading up to this was, okay, I know there's a curve out there. Where do I get it? Number one. And number two, which of these rates do I plug in to my model, assuming I have a model that can input these?
And I'll add something to that too, because I've gotten this question and have some uncertainty myself. But the SOFR here is a term, 1 month term SOFR. That's what I've seen most of the forward curves built on. But most of the floats I've seen are calculated on the daily SOFR. So what do you see as the difference between that and what should people know?
Okay, that's a great question. So I'm going to first start with just the difference between these, and I'll come back to the SOFR. So, if you were to use, I believe you can now see the screen. So if you were to come to this Chatham website, they're plotting the term SOFR, the 1 month LIBOR, and then the various 5, 7, and 10-year treasuries. Very easy to hit download. It'll pop up with a Excel sheet. And it's just, easy to copy and paste this now into your model. We'll come back to this example model. But what I do is I go into a debt tab and I just paste it in there. And so it's just sitting in there. I've got, a variety of forward curves. And then to the question that just got asked, if I get, I should have pulled one up. Maybe I will during Q&A later. But if I get a debt matrix and there's a Freddie agency that's based on a 7-year treasury versus, somebody that maybe still is using LIBOR, or if I've got an existing deal using LIBOR versus SOFR, I can just flip between these rates. So a question about, 1 month term SOFR versus daily SOFR, I would point you to the Pensford website. So Jay Conklin over there does an excellent job breaking down some of those nuances, but as a sponsor, not somebody that works in that space day in, day out, I don't want to really speak to that.
So Brian, you mentioned earlier, I just want to emphasize the point you made about as you're getting closer to a deal, getting contact and getting a quote for that specific property is so critical, because they could reference any one of these curves, which could drastically influence your results, right? So I think it's a great point.
So yeah, here's kind of an example of what I do without opening the model. So, I paste in the current forward curves, and then I'll get a soft debt quote, right? And the lender may tell me, okay, you've got a 1% origination fee. So that's just, upfront closing costs. It's a floating rate on top of SOFR. That's 3.5% on top of SOFR. And so, another kind of lingo to, sometimes your broker will tell you your all-in rate is 4.5%. And so if your SOFR today, let's just round up and say it's 1%, your all-in rate's 4.5%. That means you've got a 3.5% spread on top of the 1% SOFR today. In this example, I use 3 years of IO, 30-year amort for like a $45 million loan. So why do you need to paste this in? And then going back to Andrew's much earlier question, can I do annual or can I do monthly? Annual is fine from us. If you truly take the average annually, I mean, it's going to give you the same annual cash flows. When you might want to start thinking about monthly is for 2 reasons. One, if the property's running pretty lean today or fairly distressed, you really want to know how tight is my liquidity going to get month in, month out. And two, even if you're looking at it on an annual basis, I would strongly recommend building yourself a monthly cash flow stream once you get the deal under contract. And why is that? Well, let's use this example above, and this is just from the other day. So if you start out at 0.81% SOFR and you add the 3.5, you start out at 4.31% all in day one. Well, 11 months later, you're at 6.5%. And so, if you're sitting there day one as a sponsor, you may start making distributions or think cash flow looks great. And all of a sudden, 10 months later, your interest rate payments and your debt service has jumped up 2.5%. So I want to know that. I want to know, every month, how my liquidity is looking, how my cash flows are looking. And this is another old capital slide from their webinar. And I thought somebody sent this screenshot to me the other day. I thought it was funny, but not funny. It's pretty good. So 2021, what'd your deal look like? Everybody's buying bridge. Everybody's buying deals with bridge. That's why so many deals are getting done. You hear people getting deals done left and right. And SOFR is at 0.05. That's not 5%. That's 0.05%. Folks are buying a 3.5 spread on top of that. So they're all in rates of 3.55%, and they're getting 80% loan to cost. Loan to cost is calculated taking your purchase price plus your CapEx. So let's say you're buying a $20 million deal and putting in $5 million of CapEx, you're getting 80% of that amount of that 25 million. Today, I just mentioned SOFR jumped up to 0.81 because of some of the volatility and pressure that lenders see in the market. They've also, it's not just the SOFR rates increase, the margin now, the spreads also increase. So now you're in the low to mid fours on a lot of these deals in specific markets. So now your all-in cost is 5%. Again, that doesn't account for the fact that it's expected to go up another 2% in the next 10 months. So that's really kind of what this next year's, showing that, okay, if your margin's at 4.5, SOFR's at 3, you're now at a 7.6% interest rate, and lenders are going to continue to pull back on that loan to cost that they're financing. So it's definitely made it more challenging. You're hearing a lot about a lot more deals are being retraded. that are falling apart, but in volatile times comes opportunities, right? There's that Warren Buffett quote about being greedy when others are fearful. So I do truly think that today and probably over the next 6 months are an excellent time for people to invest in or buy multifamily. You just have to buy right and be be diligent and careful. Couple of notes on bridge debt. Usually they're floating rate, 3-year loans with 2 1-year extensions. I mentioned the LIBOR and SOFR already. Let's kind of walk through several of these points. A couple that I've just gotten more familiar with is that rather than thinking about cap rates, your lenders are thinking about a debt yield, and what that is, that calculation is your net operating income over the loan amount. And so a lot of times lenders were looking at that calculation being in the 4s, called 4.5 to 5% debt yield. They're looking for that to then expand to 7% at year 3. So why are they looking for that to expand? Well, that means your NOI is going up. You're able to cover the debt service, but most importantly, every one of these bridge lenders is running their calculations in their own underwriting model on the deal that you're buying and determining whether you can refinance out of the property, by the time your 3 years is up. And so their goal of their underwriting is to get you to that 1.25x DSCR by the time of the refinance. And they're generally, talking to some folks last 2 weeks, testing that at a 5% interest rate. And so, when we're looking at our deals with bridge debt, we're stressing it if we have to pay the 2 1-year extensions, but we're also looking at the math of, okay, can we refi at the end of year 3, and what do we need to assume? And so that's what I've tried to show here on the bottom right. This is just an example property. My NOI is about $2.3 million. My loan was $28 million. And so looking at a variety of LTVs, I'm going to need something in like the, call it, 73% LTV is about all I can max out. I think I use like a 4.5% interest rate. But again, if you're using a 5% interest rate, that's going to be, your LTV is going to drop to get to that 1.25. And so it's a pretty straightforward calculation. You're just taking your your debt payment. But that's what that table above also shows from a recent webinar, is they're looking at your NOI at a variety of LTVs at a 5% fixed interest at the end of year 3 and trying to figure out, okay, how much can we loan then today if we believe that pro forma. So a couple other things to just think about. Markets almost always overestimate the path of floating rates, but underestimate the speed of change. This is from Pensford. It's what Jay over there calls his hairy graph. And so the light lines are the forward curve projections from the market, and then the solid dark line is the actual LIBOR curve. And so you can see in all these times when the Fed hiked, generally speaking, the market was predicting they'd hike sooner than they did. But once they started to hike, right at that inflection point, they actually underpredicted. And I think, we've really seen that again recently. A lot of folks, to use, I guess, an easy term, kind of got caught with their pants down. They believed that it'd be a slow hike, and now the Fed's hiked fast and furious. They've gone from, more dovish commentary to more hawkish to try to slow down all these inflationary pressures that we're all seeing.
Right. Just to digest this for a second, right? This is going back to 1990, right? So you've got several decades here. Is the bold line the actuals, and then the hair is the forecast kind of thing?
Correct.
Okay.
So, we're kind of, you were looking at this maybe before recently and thinking, okay, maybe we're under predicting how fast they're, or, when they're going to hike. And I think it did take them longer, right? They waited into this year, well past any of the pandemic, let some of that clear out on the macroeconomic side. Now today, today, right beforehand, I think we were probably as a whole under predicting, and now we're about 1% much faster than the consensus. But what this also shows you is a lot of times the market predicts that the hikes will last longer and sometimes go higher, right? In the last hike before now, there was a lot of predictions that would go higher. So you start to think, okay, is there, some type of rosy tint or some, optimism around this? And that's what this next graph shows. So this is the Fed interest rate. And what it's showing is that, without looking at the, squinting too hard at the graph, is that tightening cycles by the Fed have generally lasted about 2 years, and the longest recorded, going back to the late 80s, is 3.2 years. So if history rhymes but doesn't repeat, we'd probably expect, the Fed started hiking rates beginning of this year. We probably expect rates to be pretty high for 2022, 2023, but sometime in 2024 for the Fed to start cutting and pulling back, and thereby making some of our debt service payments lower. So I show those two slides because what do you do about this rate cap that a lender is going to require you to buy? One, you need to know what the rate cap is going to cost you. So again, Chatham Financial, you can go onto their website, you can type in your debt amount, your term, your strike rate. So if you want to cap your interest rate at 1.5%, you type in 1.5%. And for a 3-year 1.5%, this was as of like 3 days ago, it would cost me $719,000. I think this can add 2, 3, 4% to your closing costs. I mean, that's a huge number compared to any type of money you're going to pay for legal or for some DD or some of the surveys that your lender is going to require, environmental. I mean, it's a huge number. It's really historical and unseen. And so what I've started doing is, it's deal specific, right? Like there might be deals where I need to buy a really tight cap to protect my cash flow. And there's others that I may feel a little bit more risk on and go higher. I'm not saying this is for everybody, because this is probably maybe less important, or you can manually put it into your closing costs. But what I've started doing is I also copy and paste in that pricing. This is a basis point pricing, and I can play around. I'm just going to show you an example. So if I bought a 4.5% strike, you can see my cash on cash goes down by about 0.5%. My IRR, if I'm just flipping between these, goes down a little bit, but my equity multiple goes up because I'm not spending so much money. And so it's going to be very deal specific, right? There's been deals in Austin I've considered buying a 0.5% strike for. And if I flip over to my closing costs, now my closing costs are above 5% because I'm using that cost of that rate cap, but my cash on cash is maximized. So generally what I've seen is, your Excel model is going to say anything at once, right? The lower strike, if the forward curve is correct, is going to be the best calculated Excel model. But your job as a sponsor is to figure out where you want to lie on that risk reward. Maybe you don't believe we're going to be at a 3% environment for the 3 to 5 years you have this debt. So you're willing to, compromise and maybe just buy a 2% rate cap. But you may, have investors that really want cash flow, that really want to be protected in an environment that this rate is elevated at 2 to 3%. So maybe you go spend the money up front and buy a 0.5% or 1%. So hopefully that made sense for everybody, but something to be thinking about and accounting for.
Brian, what are they capping? Is it the spread, the SOFR?
Yeah, that's a great
else?
cost. So yeah, and I meant to put that on here. So, for example, on that deal in Austin we bought at the end of the year, we bought a 2% interest rate cap. So we are capping our interest rate payments at 2%. And any time, if this curve is correct later this year, when it goes above 2%, that interest rate cap provider that you bought that with will be giving you, will be paying the delta to service that loan, right? So you're capping your interest rate payments at 2% on top of your spread.
On top of the margin. So it's capping the SOFR or whatever else index you're using. Perfect.
Yeah, so it can be used for any index, and it is capping whatever index you're looking at. Correct. And so, yeah, it's an interesting topic. There's, of course, if it's Penford or Chatham or some other interest rate cap provider that you purchase this from, there's going to be someone there that's giving you advice. But at the end of the day, it's going to be your call. I will say recently, I'm probably more on the conservative side, where I'm trying to come buy a tighter cap because it makes the returns look better. And I think you can sell it to investors as, hey, we bought some insurance. Our closing costs are higher, but we bought some insurance for this deal, and we're really going to put a cap on where interest rates can go on us over the next couple of years. Not a lot of talk to here, just again, for sake of time, be aware of what the T3 or T1 versus the T12 looks like. Here's a recent example in Houston where economic vacancy is actually climbing. You look at kind of line items. It's being driven by vacancy, lost lease, they're pushing rents, not capturing all that, but also bad debt. And I think in certain markets, and Austin and Houston are no outlier. You're seeing some additional bad debt issues percolate a little bit as the COVID rent relief checks have fallen off, as the inflation hits the working class. And so just really, don't just use the T12 and the OM. Take a look, dump it into an Excel, or just put your eyes on it and make sure that the latest financials aren't seeing any either bad debt issues or inflationary pressures. And this is just an example I was showing earlier that, or mentioned earlier that, historically maybe you would look at these actuals. This is from an Austin deal and say, okay, they're running that, 1,300, 1,250. Oh, I'm going to assume I can get that down to 1,200, 1,250. That's pretty high. Well, the reality is in Austin right now, there's a labor shortage. You can't get quality people to work. And so this is one of the more established PM groups in Austin, thousands of units. So they understand better than anybody what the true cost to run a property is. And the pro forma came in at 1,576. So always good to check with a PM, of course, before you buy the deal. This next slide, I think, ties everything pretty well together, which to Andrew's question about monthly versus annual. So, one thing I really, before I used bridge debt on my first deal was I really didn't think about the whole logistics, right? So I'm going to get this $19 million loan up front from a bridge debt provider. They're going to give me $3 million for CapEx. Fantastic. Well, the way it works is majority of bridge lenders are going to require you to submit a paid invoice, and then they'll wire a refund. They may only do it once a month. And so, that property I use as an example, replaced roofs and did interior renovation, pool work, etc. So you might have spent $400,000 or $500,000 in a month. So you better have the liquidity, because you're going to actually have to pay those invoices for some of these lenders, and then have them wire you a refund. And so I can't stress enough. I feel like majority of people that have been in the space always say, raise extra funds, maximize your liquidity. And now is more important than ever because of what we've been talking about the last 25, 30 minutes. This is an example, a $20 million loan, 3.5% spread on top of SOFR, if we just looked at it today. So today, your interest rate payment, which are these blue bars, would be $60,000. As SOFR rises over the next year, you're climbing to $100,000, and so $106,000. So now your property could be performing the exact same it was 13 months earlier, but you are now in the hole $46,000 more a month. So liquidity is important. Have interest reserves or working capital, whatever you want to call it. The point is raise extra funds for times like this, where all of a sudden, you're a few months down the road and you're paying $40,000, $50,000 a month more. I don't think I really need to touch on the record rent growth. Everybody here on the call knows we've had historical rent growth of 10, 13%. And so the second to last slide I had is just showing like base it in something, right? And so this is a fantastic area in Houston, this top table, and it's grown. This is I think an Axio Real Page table. It's grown 12%. It's projected to grow like 10.5% this year, 10.3% last year. It'd be easy to just go grab that and say, I'm going to be conservative and underwrite 4%, 5%. Well, the forward projections are 1.7 to 2.6%. It's because of some of the product coming online and just all the other inventory in Houston. Same thing, Austin. You've had this record rent growth in Austin, 15, 20% growth we see on lease trade outs, but the party can't last forever. Inventory will come online. The working class can't continue to pay rates that are outpacing their wage growth. And it's still going to be healthy. It looks like CoStar still estimating, call it 3.5% long term, but just base your estimates in something. And then lastly, here's some helpful links. I want to give a shout out to Pensford, showed several things from them. Great blog. If you're not on their blog, sign up tonight. I've learned so much just from the weekly blog emails that he sends. Chatham is where you can get those forward curves and interest rate caps. Multifamily loans, Janover Ventures, great description of each type of debt that you can. It's just a great resource to go to. And then lastly, Lone Star Capital. So, they're another sponsor, or A.CRE, but both of those providers both of those groups, I should say, have free underwriting models on their website that are better than the majority of ones I've seen in the space, because they they model monthly cash flows and let you put in floating debt. Andrew, I'll turn it over for some Q&A.
Well, that was absolute gold, man. Thank you. And every time you and I talk about this topic, I feel like I've got a gist of it, and then I find out I learn something new every time. So that was fantastic. So thanks for breaking off some knowledge. We got some time. We were able to pepper in some Q&A throughout the session. Does anybody on the line have a question? I've got a couple. I'll hold them. I'll let you guys go first, and then I'll dive in. I mean, you were so thorough in your presentation. It didn't leave much for curiosity, I guess.
That's good. Now I'm glad we got some questions answered live. But yeah, if you got anything, go ahead and shoot.
Yeah, I mean, how often are you refreshing that model with the data? Is it necessary to do it in every deal? Like you and I are kicking around 3, 4, 5 deals a day sometimes. Like, do you do it every day? Are you doing it once a week? What's a safe conservative approach for how often I need to refresh that data?
Yeah, I mean, definitely a personal opinion, but I like to refresh it just every Monday morning. Now, if you're in a best and final, then definitely go pull the latest rate and rate caps. And yeah, I saw Catherine mention they killed a few deals now on rate cap alone. Yeah, I mean, some of those stories you hear out there, like I said, there was that example. I had dinner with a debt broker the other night, and he was talking about a client of his that, yeah, it literally went from being a couple $100,000 to over $1 million. I mean, you can't go forward. So yeah, definitely update things at least once a week.
And there's some huge differences there. Like you showed, I mean, $1 million for a cap or $500,000 can easily make or break what you have going on. And especially if you're most of us are on the window of, that 12, 13% IRR, and you put that in and suddenly you're no longer competitive, right?
Yep.
So it looks like Chris agrees too. What are some of the common mistakes you see made by, I think you and I both know, even the larger names indicators? What are you seeing in the models you've analyzed?
Yeah, so I mean, a lot of times I think, generally it's the year one increase in income is just too aggressive. But on the debt side specifically, since that's where the topic focused, a lot of people, I mean, myself included, I mean, just to get these deals to pencil, have to assume a refi, and you can pitch it to investors as, hey, like, we've got this refi built in, but it's because it's this 3-year bridge debt. And so I'll be honest, like, even, in the past, I was kind of sloppy, just saying, well, it's anybody's guess. I'm just going to put this at like a 4.5% fixed and 75% LTV. So I kind of glossed over it, but that math of really checking and saying, okay, no, I need to go look at, if I'm going to assume a refi, what's my debt, my DSCR at the time of refi, and I've got to be at least a 1.25, and then that will tell you what the loan amount you can get is. And a lot of times on some of these deals, I'm finding that, like, if we're going to assume a refi, we can only underwrite, say, like 65% LTV in the future. And so that's a big one, is just everybody's, assuming a refi, but it might just be some like placeholder. Hey, I'm going to refi at 4 or 4.5%. And the other was just not underwriting the curve. I mean, I think almost everybody is now, like, it's such a topic at the water cooler that everybody's talking about interest rates. So I don't know if we'll see much more of that, but I saw so many deals that just were bridge debt or floating debt that they were using the all-in rate today and just holding that flat. And it's going to be several percent higher, which is going to hurt cash flows.
And I've actually seen the opposite. People are like, well, I can't get this deal to pencil, and they're using the max rate for the whole period, which you're not going to win many deals that way either.
No, that'd be tough. Yeah, that'd be very tough.
Absolutely. Anything else, guys, on the line?
No, that's helpful. Thank you.
Awesome.
Yeah, definitely. Just wanted to share what I've learned. I'm glad we had about 15 people, I think 30 sign up. So hopefully it was of value, and reach out with any questions.
Yeah, we'll get this loaded on the YouTube. We got the recording, we got the video. I may try to parse out the audio for the podcast, although without having the visuals, I feel like it might be tough to follow. I think that's a big part of this.
Yeah.
But thank you so much to everybody. Thank you especially to Mr. Brian. Really, really great stuff. If you guys have other ideas for future sessions, we've got a wealth of people we can tap into. Shoot us an email. I dropped Brian's info on there. I've got my info in the chat, and like I said, we'll get this posted. Feel free to share and steal. No shame in leveraging what's been done. So awesome.
Yeah, it's good talking to similar-minded people. You all have a good evening.
Take care, everybody. Until the next one.
See you, Andrew.
Take care.